Why do we often hear about the richest people not paying taxes? Taxes constitute the most substantial deduction from your annual earnings. It's not primarily due to the wealthy engaging in illegal activities, at least not most of them. Instead, they comprehend the intricacies of the tax system. Their methods are understanding this system, adhering to regulations, and employing tax reduction techniques. The positive aspect is that anyone can use these tactics as long as they know them. Today, we will explore the legal approaches to safeguarding your money and minimizing tax liability. Writing off your expenses. The world's wealthiest individuals amass their fortunes primarily through entrepreneurial ventures. Leveraging a powerful tax-saving strategy, they strategically write off their expenses to reduce their potential tax obligations. Understanding and applying this tactic can significantly lower your tax burden in everyday business operations. For instance, consider you're running a small tech startup generating $300,000 in annual revenue. The entire amount would be subject to taxation if you had no business-related expenses. However, by incurring legitimate business expenses totaling $100,000, such as office meals, supplies, logistics, travel, maintenance, and contractor services, your taxable income is reduced to $200,000. This means you can effectively circumvent paying taxes on 33.33% of your earnings. This method isn't limited to large corporations. It can benefit businesses of all sizes and even certain personal income situations. It's the key reason business owners often pay fewer taxes than individuals earning income from traditional employment. Understanding and utilizing this tax strategy can significantly benefit your financial situation. Get an IRA. An individual retirement account, IRA, is a valuable financial tool that allows you to invest your income while deferring tax payments for a significant period. Often utilized by the wealthy, this legal strategy enables individuals to reduce their tax liability because every dollar contributed to an IRA becomes eligible for tax deductions, with the tax being refunded annually when you file your tax returns. To take advantage of this strategy, consider opening and funding an IRA to safeguard and grow your money over time, effectively delaying the taxation process. Ordinarily, income earned through employment is immediately subject to taxation. However, by diverting a substantial portion of your income into an IRA, you can only delay the payment of taxes later. Let's illustrate this with an example. Suppose you earn an annual income of $50,000 and are typically taxed at a rate of 15%. Without an IRA, you would pay 15% in taxes on your entire income, which amounts to $7,500. However, you can reduce your immediate tax liability to just half of that, or 7.5%, with an IRA. This is because the money you contribute to your IRA is not immediately subject to taxation. Instead, you pay taxes when you eventually withdraw these funds, often decades down the line. Additionally, during your retirement, your income will likely be lower than $50,000, resulting in a lower tax rate on the money you withdraw from your IRA, maximizing your tax savings over time. Netting revenues against losses. Statistics reveal a challenging reality for small businesses, with a substantial portion facing failure in their early years. Specifically, 20% of small businesses still need to make it past their first year, while 30% falter in their second year. The 5-year mark sees a staggering 50% of these businesses closing their doors, and the 10-year milestone witnesses 70% of small business owners experiencing failure. The statistics indicate that more than 90% of all small businesses eventually meet the same fate. However, it's crucial to understand that while these statistics may seem discouraging, there are still opportunities for success when embarking on a business venture. One valuable strategy to enhance your chances of success is the concept of loss carry forward. Many businesses require a few initial years to become profitable, during which time they often incur losses. These losses can serve as valuable tools for minimizing future tax liabilities. The wealthy know this strategy and often incorporate it into their long-term business plans. Loss carry-forwards allow you to offset your previous losses against your future earnings, effectively reducing the total amount subject to taxation. In practical terms, a smaller portion of your income will be taxable, offering potential tax savings and improved financial stability for your business. One of the most important rules of business is to make sure that you're not going through any losses. This method is possibly the smartest one in this list, so make sure to not overlook this one. Buying yourself an annuity. An annuity is a savings vehicle housed within an insurance company, designed to provide tax advantages. However, it's important to note that there's a trade-off involved, as you must pay an additional fee to access these tax benefits. While annuities do offer tax savings, this benefit comes with associated costs. The optimal scenario for purchasing an annuity typically arises when you've fully maximized all other retirement savings avenues and your mortgage has been fully paid off. While only some reach this financial stage, many diligently work towards it. It's essential to understand that the primary purpose of acquiring an annuity isn't solely for tax savings. Annuities come with additional features, such as protection from creditors, a range of investment options, and potential benefits for your heirs. To make the most of an annuity, consider these other advantages in conjunction with the tax-saving aspect, which can provide you with a more comprehensive and advantageous financial strategy. Charity and donations. It may sound surprising, but many individuals effectively navigate the world of taxation by leveraging charitable donations. Philanthropy gives back to the community, particularly when one has amassed more wealth than one can personally manage. However, this practice brings forth additional benefits. When you channel your funds into charitable causes, you reduce your taxable income and contribute positively to society's well-being. Numerous billionaires across the globe have embraced philanthropy by generously donating their wealth to various charitable endeavors. These individuals, who often started with humble beginnings, have become some of the world's wealthiest. Yet, they allocate a portion of their fortunes to support noble causes. Examples of such philanthropic billionaires include Jeff Bezos, Bill Gates, and Warren Buffett. Although they pay charities millions of dollars, at the end of the day, saving their own money is what these people are after. Leveraging geographical tax laws. Many might assume that relocating their business is not only costly, but also detrimental to their business prospects. However, what if such a move could yield a return on your investment and enhance your profitability by 10% to 20%? How might you achieve this? Wealthy individuals are privy to a little-known fact. Every U.S. state applies varying tax rates to its most affluent residents. Take Silicon Valley, where the highest earners face a federal tax rate of 13.3%. While federal taxes are unavoidable, there is significant room for optimization regarding other state-specific taxes. The solution to this quandary is considering relocation to states with lower or no income taxes, such as Texas, Nevada, and Florida. By making such a move, you can circumvent the hefty 13.3% tax burden experienced while residing in Silicon Valley, opting for states where taxation rates fall below this threshold. Similarly, there are several locations spread throughout Europe as well, where geographical tax laws can be leveraged. If you're willing to relocate to save more money, then choose the location that has a low tax rate and a higher quality of life. Investing in real estate. One of the strategies employed by the world's wealthiest individuals to continually grow their wealth is harnessing the power of investments to generate passive income. A prime avenue for achieving this financial growth is through real estate investments. When these affluent individuals acquire properties, they acquire a depreciable asset. This asset, over time, naturally decreases in value, which opens up a valuable tax-saving opportunity. The essential advantage lies in offsetting the asset's depreciation from its taxable income. Several factors contribute to this depreciation calculation, including expenses related to repairs, the asset's age, its type, and significant miscellaneous expenditures. However, it's essential to be aware of a crucial caveat in this tax-saving strategy. If they eventually sell the property for a higher value than its depreciated worth, they become liable for taxation on the gain, typically through the depreciation recapture tax. Many wealthy individuals opt to retain their investment properties rather than sell them outright to work around such tax implications. Additionally, they often pass these properties down to their offspring through trust accounts, ensuring the continuation of their wealth-building legacy. Issuing stock options. This ultimate secret employed by the wealthy is a remarkably clever approach. It offers convenience for two compelling reasons. First and foremost, stock options are recorded as expenses, effectively reducing profits and taxable income. An astute maneuver indeed. Secondly, and equally brilliant, it doesn't necessitate an actual cash outflow for the business. How ingenious is that? When a company issues stocks, it records them as an expense on its financial statements, which decreases its profits and, consequently, the taxable amount. Importantly, this accounting practice doesn't entail any actual money exchange, allowing the business to preserve a robust cash position while simultaneously reaping the tax benefits of expense deductions. Furthermore, companies adopting this strategy optimize their financials and bolster the stock prices for their shareholders, adding another layer of brilliance to the approach. By consistently issuing stock options year after year, the wealthy can effectively minimize their tax liabilities, making it a viable strategy when other tax-saving methods have been exhausted. Use a health savings account. Individuals enrolled in a high-deductible health insurance plan can tap into a valuable resource known as a health savings account, HSA, a financial tool that not only aids in managing healthcare costs, but also serves as a tax-saving mechanism. Much like a 401k, contributions made to an HSA by an employer through payroll deductions are exempt from the team member's taxable income. Moreover, employees' contributions directly to their HSA are fully eligible for tax deductions, effectively reducing their taxable income. A high-deductible health insurance plan coupled with an HSA can provide employees with the dual benefit of managing healthcare expenses while optimizing their tax situation. This financial strategy bolsters financial health and offers tax advantages, making it a prudent choice for those seeking to reduce their tax liabilities. Conclusion: using these techniques, you can hack the tax game and avoid paying it in high amounts. Since these are legal methods, you won't be misusing the system at all. Using these methods, you'll feel a significant difference in your wealth since you'll save most of it.